this is Abhijit Chatterjee recording our weekly session for Chartsarefun. This is for the week of July 28th, recording this on August 3rd, Sunday morning. Last week, we had Chair Powell talk about the FOMC rate decision. They held it steady, but he did express some hawkishness in terms of market was expecting a clear indication of the rate cut coming in September. He did not budge. He felt that he still was data dependent. He had to watch the employment and the inflationary data for the next couple of months into August and September. And then in the September FOMC decision, when clearly asked if they had made up their mind about the cut, he denied it, saying they'll just have to reevaluate the data and then decide at that point during the meeting. There was no discussion of a committed cut in September. Market didn't like it. So into Wednesday afternoon after the press conference, which typically starts around 2:30, goes on till up to 3:30 or so. After that, during that period, market sold off, got a little bit of recovery into the close, but then a huge gap up, and that's the kind of, call it the exhaustion kind of gap up onto Thursday morning. That was because of two strong earnings from the Magnificent Seven, the two of the strong ones, Meta and Microsoft. Both AI-led, huge earnings. We can talk about that. And then Thursday came, and that was the expectation of the tariff deadline on August 1st. Thursday was July 31st. After the kind of gapping higher, touching some new fresh highs into S&P 500 and QQQ, the market sold off through the day and then gapped lower on Friday. One was Amazon kind of disappointed in growth. The bar was set way too high in terms of cloud growth, AI-driven cloud growth in Google the week before, and then the Azure on Wednesday. And then Amazon's was, less than half of Azure's. So Azure had a 39% cloud growth. We talked about Google at almost 32%. And here, Amazon, the behemoth, the largest cloud provider, was at 17.5%. So we'll look at the key sell-off that happened on Friday. We'll look at hourly charts to see after this sharp sell-off, are we expecting, looking at some indicators like market breadth indicators, are we expecting some form of a rebound starting tomorrow, Monday, into a few days into early next week before we get the a deeper sell-off? And we'll kind of talk about a target where we think the market could be headed in the next few weeks. So with that, our Chartsarefun Substack site is chartsarefun.substack.com. Just subscribe with your email, and we'll send you the charts as soon as they're available in the mornings of every day. The YouTube site is also Chartsarefun, at Chartsarefun is a channel. Appreciate you subscribing to the channel, and then if you hit the like button, it helps us promote it to other users. So talking about the unemployment data, which is the biggest shocker into Friday's gap sell-off. It comes out at 8:30. It came out on the first day of August 1st, for the month of July. We can see that the article that we're showing you here is for the month of July. The number of jobs added was 73,000, way below the expectation of almost 110,000 jobs was what the market was expecting. So that was a big drop. But the bigger thing that shook the market, that led to firing of the Bureau of Labor Statistics commissioner by President Trump, was the big kind of republication or reassessing the actual jobs that were added in May and June. They drastically brought those numbers down. June was brought to 14,000, and the May jobs was brought to 19,000. And these were much higher numbers. We're talking about close to 258,000 jobs that were adjusted into May. So which means those preliminary numbers that were released before were way off with respect to the reality. This led President Trump to really express his frustration about how the labor mathematics are all adding up. He, of course, complained to the labor numbers from the before the election and how the 50 basis point cut was done during that period, trying to help the other political opponent for his. So That Bureau of Labor Statistics chief was fired. Moving forward, we have to see if that's really the case or it's just the way the mathematics or the way they calculate these labor data needs a rehaul. But definitely, it's unnerving to the market when you have such big adjustments to the labor data. And in this case, we could see that clearly, 258,000 or so jobs adjusted lower with 14,000 in June and so trending lower, 19,000 in May going into 14,000 in June. And the 73,000 for all we know would be readjusted lower as well. If that's the trend, and we know that there's been a lot of government job losses in the Washington, D.C. federal jobs. These numbers seem more realistic. The 14,000 in June and 19,000 in May. So that 73 is likely to be downward adjusted. Now, what does this do? We know that there are two mandates to the Federal Reserve when they make interest rate decisions. One is maintain inflation, price stability, and the second is maintain full employment. Well, employment from Fed's perspective has been full, fairly decent unemployment numbers, though for the month of July it crept higher from 4.1% to 4.2%. In reality, many say that even that number is not quite reflecting. If you look at graduates graduating from college, their unemployment, I mean, the chances of them finding jobs is significantly low. So they're struggling. So there's no job creation. It's pretty much employers holding on to existing employees and their jobs and not quite a reflection of the job market in the economy, though Fed keeps saying that the job market seems stable. So now there's strong expectation that there will be a cut in September, especially after seeing the revision onto the May and June job cuts and the 73,000 that likely will be revised lower as well when we hear the September or the August jobs coming in the first week of September. So that's something for us to watch. And that a rate cut, when finally decided, will definitely help small caps. They are gearing up to break out higher, uh, looking at rate cuts because they're very interest rate sensitive. So that's something, and the housing sector, those two for sure. But that said, the earnings was the other big news last week. And in particular, Google had already announced Google Tesla the week before, but this week was four of the Max 7. In fact, even Netflix had announced the week before or the 2 weeks before. The key earnings that came out was on Wednesday, we had Meta and Microsoft. Both blew through their numbers. And then on Thursday, we had Amazon and the Apple. Now, some of the key things on the cloud side is Microsoft blew through numbers. They crossed the 4 trillion as soon as the numbers came out. Massive gap up in their stock. They projected very strong cloud, which they call as Azure growth of 39% year over year. So for this quarter, their cloud grew 39%, and for the full year, that cloud Azure grew at 34%. They're currently doing an annual run rate of 75 billion of Azure cloud, which is second compared to Amazon's cloud at about 123 billion. They run rate of about 30 billion quarterly kind of cloud revenue. So Amazon at 123 for the annual cloud revenue, Azure at 75, trending higher, and then GCP is at a 50. So those are the top three cloud providers. And Google's growth was pretty handsome as well. Google grew their cloud growth quarter over quarter at 32%, Azure at 39, and sadly, in comparison, the cloud growth at Amazon was less than half of Azure at 17 and a half. So that market didn't like. Amazon got hit on Friday after that news. Apple had a huge surprise. Apple people were very bearish about iPhone sales, their AI being lagging, thinking that iPhone 16 wouldn't quite get the momentum of sales with the AI lagging. But guess what? The tariff concerns, knowing that Apple is being hit by President Trump because of the manufacturing in India, India's tariffs have increased to 25. They were worried, and hence clients, customers were buying up iPhones ahead of the tariff related price increase on the iPhones. So they saw a solid 13% year over year increase in iPhone sales, one of the strongest since late 2021. Overall revenue for Apple grew at 10%. not just the iPhones, but across services, across the other products. So Apple surprised the market. It did initially jump higher, but then as the market sold off onto Friday, Apple kind of gave up those gains as well. And Meta is just absolutely firing on all cylinders. By far, they had their best kind of revenue of 22% and EPS of 38% year over year. Outstanding numbers. 3.48 billion daily active users across their app ecosystem. And what's most promising is with their Meta AI, which launches as a chatbot in their WhatsApp monetization is now expected to bring in almost close to, say, 25 billion into this year of revenue and growing up to 50 billion by 2030. So very, very strong growth opportunities in WhatsApp, and they're across their AI monetization on their app ecosystem, whether it's Instagram, whether it's their Facebook and their Messenger. Very strong momentum in Meta. They, of course, have upped their AI spending, have gone at some very strong talent from OpenAI and from Google and Microsoft. Some of the strong AI talent have all been lured away by Meta, offering massive signing bonuses into the tens to hundreds of millions. And Meta is basically betting on what they call as a super intelligence. They're going to really take their llama model into steroids, come up with that next generation llama that beats everyone hands down. That's what Mark Zuckerberg is after. So now let's look at the sell-off that happened onto Friday. This is the hourly chart of QQQ, which is a NASDAQ 100 ETF. We can see that through the week, that is from the 28th, it had been flatly staying in that 567 to 570 level. And then on to Thursday, after strong earnings from Meta and Microsoft on Wednesday, Thursday morning, it gapped higher and opened near 575. We've been blogging about this. We've shared in our previous YouTube videos that a calculated ascending triangle pattern on QQQ from that April breakout. The April low was at 402. The May 1st, May 2nd high was at 490. That's $88. 402 to 490 is $88. Add 88 to 490, 578. That was the ascending triangle target for QQQ that we had talked about. It didn't quite meet the target, but came very, very close. In fact, in 574.63 was the level in when it opened in the market, but in the pre-market, it did hit 577. So it came very close to our 578 target in the pre-market. From there, it sold off through the day. Throughout Thursday, we can see from 574, a waterfall decline, selling distribution throughout the day to the point where on Friday, after the jobs disappointment, a big gap lower, jobs disappointment, and Amazon's earnings together brought a gap down into QQQ. And then it kind of tested a low at a very key level, which is from the previous lows back on the 14th, on the like, in fact, towards on the 11th, and then on the 16th, that 551 and a half, 551.5, 551.6 is a key support from where it reversed higher. And that's exactly what it tested again, 551.88. Then it retested as a double bottom at 551.68, the second bottom slightly lower than the early morning bottom. And then from there it recovered, tried to recover with a strong volume close. Each of these candles is 1 hour of trading. This is an hourly chart, a 60-minute or an hourly chart of QQQ. So we can see that it rebounded to come back and test. It had fallen below the 200 period moving average in red to come and test that from below. Now, the positive divergence that we see here in RSI in the hourly chart, as it tested the bottom twice, that's a classic double bottom test at 551.78. The RSI was a higher low, and so was the MACD histogram at a higher low. This indicates a reversal possibility into tomorrow in the first part of the week. And we think that we will likely get a retest of that key top of the gap. We can see that the gap, top of the gap was at 559. So now that becomes key resistance. And perhaps it might be able to go close that gap at 565 or about that level. And from there, we expect a decline. So this is potentially setting up for a rebound. If you look at the advanced decline line also on an hourly chart, we can see that after it gapped lower and tested an extreme low from the previous entire month, it hadn't tested that low of minus 2755. That's the net advance and decliner. So there was a net 2,755 companies in NASDAQ index that were declining versus the advancers. Net decline was minus 2755. From there, it printed higher lows. That indicated that market was recovering. The declines were reducing to the point where it closed near minus 2,100. 2,119 is where that number closed at. So minus 2755 to 2119, that's about 600 issues were no longer declining. They had started advancing. So that kind of a reversal indicates that that intraday market was buying coming on. And that corroborates with the positive divergence on the relative strength index and the fact that the second test saw buying with strong volume in the last hour of trading as price started recovering from 560, so from the 551 level, closing near the 553.88 or 554, somewhere around that. The other thing is an extreme oversold from the oscillator. NASDAQ has an oscillator, which is also measured based on market breadth, advanced decliners. That oscillator we can see had touched a very sharp level from minus 77 on the April 7th low up to 84.8, near 85 in the late April. And from there, it's been basically printing lower highs to the point that that was a divergence as the market QQQ was climbing higher highs. We can see QQQ climbing higher highs through all of July. The oscillator was actually printing lower highs. We can see from 43 to 28 till the point it broke down. So that was a negative divergence. And we can see that the 50 period moving average here is about to cross below the 200. And that indicates this downward trend. That said, the oscillator is at an extreme oversell level at minus 72. Look at MACD. The signal line is lower than any of those levels we saw in the entire last 1 year almost. So we can see that it's at an extreme oversold level. And from here, there's a possibility we could see a rebound. RSI is also close to a level that we have not seen almost near 30 at 31. So here we can expect a rebound because of that oversold oscillator, indicating the rubber band is stretched too much in the other direction from plus 85 to minus 77, potentially, minus 72, above the minus 77 from April, potentially setting up for some form of a rebound into next week, just from oversold levels. S&P 500 hourly chart shows a similar kind of a double bottom test, a gap down again on Friday like QQQ. It had gapped up on Thursday from that strong earnings from Meta and Microsoft. It touched 64.27. The measured target on here, by the way, that ascending triangle you talked about, was 65.65. So this came nowhere close to that ascending triangle measured target at 65.65. It came at 64.27, and from there broke down, a gap down onto Friday, and from the gap down tested that critical 6,200 level. We can see that 6,200 level on July 7th and then onto July 16th, tested twice here, but that is now key support, which is exactly where it rebounded at 62.12. Tested that level twice early in the morning and then before an hour before the close. And into that second close, we can see that positive divergence in RSI higher low and the MACD histogram curving higher. That again indicates, and look at the strong volume in the last hour of trading in S&P 500, indicating that the market wants to recover, improving internals of the market, indicating buying coming into from smart money. So that the fact that positive divergence on the S&P 500 in its double bottom test, and also in the QQQ double bottom, QQQ happening at 551.8, and into S&P it was at 62.12, the double bottom test, indicates a good chance that we will see a market rebound into next week. Now, a couple of indicators that correlate to the S&P 500, not the NASDAQ, but the broader New York Stock Exchange. This is where the bluest chip stocks trade, and S&P 500, is a big 500 top blue chip stocks. This indicator, the summation index, is a longer term intermediate cycle indicator. It typically goes from minus 1100 to plus 1100. Most recently in the 2022 bear market bottom, on the October, it had hit minus 1100. in a few months, it had tested plus 1100. Since then, it tested that close to the 1100 again later in 2023, and more recently in 2024, around the late September, early October, it tested that. From there, it had been declining to the point that it tested a higher low at minus 590 from the lows in October of 23 and lows of October 22. And it recovered from that April low at minus 590 to up to 937. This is a weekly chart. Every candle here is a week. 3 successive weeks of decline. We can see that the MACD histogram has started dipping lower. The black signal line has curved lower to go below the red line, indicating that the next few weeks into August, we may get a rebound, which we are expecting of S&P and the QQQ from its hourly chart, from a short-term chart, but that could fail. And we expect the S&P to break below this level of 62.12. A measured target on that would then be 62.12 to 64.27. We're talking about 215 points. Subtract 215 from 62.12, that takes us to 59.97, just below 6,000. That's the measured target that we expect for S&P, where we would start dipping in and buying some from a bullish side. Same thing with QQQ. The measured target in this case is 551 to 574. We're talking about 23 points on this difference from the top to the neckline here at 551. So right shoulder forms, then the breakdown. So 551 to 574, 23 points subtracted from 551 takes us to 528. This would help close this gap from June 23rd. This gap is at 532. We expect that to close and go closer towards the 528 on this measured target. Same thing with the S&P 500. We expect this to come down and close that gap from June 23rd, and dip down below. This gap is somewhere around 6,050 and something above 650. Close that gap and dip at below 6,597 on this measured target from 62.12 to 64.27. Now, we're going to talk about another key indicator from the summation index, which, as you said, is an intermediate cycle indicator, is volatility, the fear indicator, or call it the puts versus calls on the S&P 500 index. This we know is being in a lower bound range in the recovery of the bear market bottom of 2022. It was hovering in a range between 23 and 12. Since the move into 2024, the Japanese carry trade collapse, VIX had shot up to 65. That was the Japanese stock market crash. Came back lower to the 12s, but notice that it tested a higher low from the 11s that it had tested in 2024. This was at 12.7. Now we have another spike into the tariff-related sell-off, hitting a 60. However, look at where we are. The new low on VIX is at a higher low from the 12.7. The recent low was closer to 14.7. So higher low. Overall range on this now, we can see that the moving average of the VIX, this is the weekly chart, is now showing the shorter term moving average, the 50 period shown in blue and the longer period shown in red. The 50 is about to cross above the 200, indicating for the next several weeks expect high volatility. So from a lower band staying between anywhere from 11 to 23, expect this to stay in a range from, like we've seen at that time frame in the 2022 level, in the 14 to 15s to the 35 level or 38 level. So we expect VIX to climb. We expect in the next few weeks into August, as S&P comes down towards the 6,059.97 measured target, if that's the near-term target we're looking at, or QQQ towards the 528, expect VIX to climb further, hit the 30s and a little higher. Nothing good happens. There's a nice quote in Wall Street. Nothing good happens when VIX is above 20. And guess where VIX closed on Friday? Above 20 at 20.38. So if VIX stays elevated, stays in that 20 to 30, 35 region, expect market to see some sell-off after a little bit of a rebound next week. Now we want to end with Bitcoin. This has been in the news, tremendous amount of bullish momentum. First of all, the reason we always look at Bitcoin is it trades 24/7. So if we are expecting that the market might rebound into next week coming out of the Friday lows, One chart as a parameter to look at is Bitcoin chart, because we know Bitcoin didn't stop trading on Friday, which the market did. Bitcoin traded into Friday evening, Saturday, and Sunday. So guess what happened? Bitcoin into Saturday defined a lower low. So August 1st ended. So Bitcoin typically goes at Greenwich Mean Time. So when it changes from August 1st to August 2nd, that's 8 p.m. Eastern is 12 p.m., 12 midnight, 12 a.m. Greenwich Mean Time. So it closed the market on at 8 p.m. when the market closed at around 112.7. It rebounded to 114 and broke down onto Saturday, late Saturday evening, testing the 112,000 twice. We'll show why 112,000 is such a key indicator. One is this breakdown from 119.8 to 115.8. That's a $4,000 difference from the dome shape pattern here. You can see it's, if you can trace a dome around it, a nice dome that kind of wraps around 119 and comes back towards the 115.8 level. So 4,000, 119.8 to 115.8, 4,000. Subtract 4,000 from 115.8, that's 111,800, which came very, very close to test 111,900. So it met that pattern. Look at that beautiful positive divergence. As Bitcoin, this is Bitcoin's 60-minute or hourly chart, lower lows, RSI is at higher low, which means that pattern at 112, double bottom tested twice, is happening with positive divergence, in MACD. MACD at a higher low, RSI at a higher low, indicating this likely is a bottom for the near term. An expected move here is potentially either an inverse head and shoulder or a cup and handle. The cup is between 111.9 to 114.3. So you're talking about 2,400. At 2,400 to 114,300, 116,700, which is somewhere around 116,900. That level, in fact, 116,900, 800 is where the 200 period moving average, or in this case, the 200 hourly moving average is. That will likely decline to the 116. So this is going to already broke above the 50 period, go up towards that. So that's where we think Bitcoin is headed for the bulls. Holding the Bitcoin miners, holding Bitcoin ETFs, expect that nice rebound to be able to book some profits and make some nice trades, heading from 114 towards the 116,700. That's our target on Bitcoin, looking at the hourly chart. As we said, either this is a cup and handle from 114 to 111.9 back to 114, a shallow handle and then a breakout, or an inverse head and shoulder. If we see some more selling this afternoon, Sunday into Sunday evening, we could retest that 112.7. So that's the left shoulder, that's the head, and a right shoulder pull back to 112.7, and then a breakout into tomorrow. Or this is just a cup, shallow handle, may not go as deep as 112.7, test around 113, and then from there break higher. But that said, looking at the positive divergence RSI, MACD, we are very confident that Bitcoin is seeing higher values tomorrow, likely headed towards 116,700. Now, a little longer view, let's look at where we think Bitcoin could be headed at the weekly chart. This is a beautiful cup and handle from 69,000 testing to 15,400 to 73,000. So that's 15,000 to 73 is 58,000. Add 58 to 73.8, that takes us to 132,000, 131.8 or 132,000. That's where we think Bitcoin, one of its target is, if you look at this as the cup and handle. As we said, the cup between 69 to 15.4 to 73.8, then the pullback forming the handle, and then the breakout. However, there's also a cup and handle pattern here more recently in the 2025 timeframe, 109.3 down to 74 up to 112. 74 to 112, you're talking about 38,000 as the depth of the cup. Then a pullback, handle pullback from 112 to 98. So 38 to 112 measures to 150. So this cup and handle measures to 150. This broader base kind of cup and handle measures to 132. However, the mega bulls are painting even a higher picture on Bitcoin based on what they call as a bullish flag pattern. So the flag pole here is from 74 to 123. That's the climbing flag pole. Now the pullback from that flag is happening where the flag is being formed. Fairly lower sloped flag. Usually flags are more shallower slope, but in this case, if you join the highs and the lows, that's the flag forming. If that's the flag pole, it's already tested a key support level of 112, as you showed on the hourly chart. 112 got tested twice, right? We saw late last night and then early this morning, 112 getting tested twice. So that 112 testing out that key, what was resistance as key support now, reversing higher, that measured target on that 74 to 123, you're talking about close to 49,000. So 49 to 123 takes us to 172,000. So another possibility, if the people who are bullish, extra mega bullish and looking at this bull flag pattern, measure to a target to 172. So we talk about, in summary, three targets on Bitcoin. One is on this cup and handle, on the broader cup and handle, between 15 to 73, measured to 132. A near term in the 2025 cup and handle from 109 to 74 to 112. That measures to 150. And then for the bulls looking for a 74 to 123 bull flag, bull flag pole, and then a bullish flag, and then a breakout to 172. So we'll see, is it the 132, 150, or the 172? Which target happens to be the reality? Looking at a very long-term chart, and this is the monthly chart, every candle is a month, we notice that every time halving happens, like the last halving happened in 2016, after the halving, the market takes off. So this is the 2016 halving, and from there the market took off. And look at how bullish vertical that climb was, right? And typically into every climb there's a nice cup and handle. So there's a 676 to 776 is the two brims of the cup, the pullback to 157, that's a cup, a shallow handle, and then the breakout, a parabolic climb. So that's the first, that's the halving of 2016. Then another cup from 19,000 to 3,000 back towards the 19,000, and then the takeout. That takeout happened after the 2020 halving, another parabolic climb. Now, this is the halving that happened in 2024 April. That's a beautiful cup again, 69 to 14 to 15,000 to 73, a handle, and then the breakout. This breakout is got some more legs. If you look at the extent of the climbs, this is just about taken off. We said 1, 2, 3, 4, 4 months of climb. We shall expect to see the bullish momentum for this to take at least 3, 4 more months of climb, taking us likely towards the 172. Would not be surprised to get there. Beautiful climb on the MACD, regaining strength, climbing higher highs. The signal line, the black, as we can see, is climbing higher highs. The RSI is also now above 71, showing momentum. That said, from a longer term perspective, this 172 could lead to a sharper sell-off. Why? Look at RSI hitting lower highs as this is going on. Lower highs declining in momentum. The extent to which percentage-wise these climbs are happening is becoming less and less stronger. Much stronger momentum on RSI, weaker than that in the 2020 climb, and now further weaker in the 2000 percentage-wise in the 2024-25 climb. So that said, we could expect a sharp pullback. We can see there's a very big gap between the 50 and the 200 week moving averages. 200 week moving averages at 50,000. The 50 is at 90,000. We wouldn't be surprised, not at least to the 50, but from that 170, a pullback to test key level at that 73.8, 74 cannot be ruled out. So that's even if it hits 150 to 73, talking almost a cut in half, right? More than a 50% cut is a possibility we expect into next year. So after this parabolic climb, after this climb that we see here from the halving, this is as typically happens in a monotonic way, month after month, it just goes off in a momentum, climbing that parabolic peak, same thing going on here. That parabolic peak, once it gets there, like we've seen sharp pullbacks to test that longer term trend line, we can see that this longer term trend line is actually at 52,000. So it could even cross the 75 level and even go deeper, but this is climbing, and by the time we see the pullback, that 52 could perhaps climb a little higher towards the 60s because the trend is higher. The moving average keeps climbing as the trend remains higher. So we'll see what that does. In summary, we looking at the hourly charts of both QQQ and S&P. We see a double bottom test with positive divergence. We expect a recovery rally. That recovery rally isn't going to last. It'll take us perhaps to a gap close, lower high from the 574, maybe towards the 560 or the 565, and then a break lower. That break lower from 574 to 551, 23 points subtracted from 551, 528 is our target near term in the next few weeks on QQQ. The S&P target is from 6212 to 6247. That's 215 points. Subtract from 6212. That's 5997. That's where we see S&P's target. And with that, good luck investing. We do expect some upside in Bitcoin. For those who are long in Bitcoin, we expect this cup and handle breakout above 114.7 or 114.3 from 111.9. That we're talking about is close to 2,400 points added to 114,300, 116,700, which is where the 200 period moving average is declining into. So that's potentially where we think Bitcoin is headed into next few days of this week. Good luck investing. We'll talk to you next week. Thank you.